Most people watching this already know they should be saving more. That is not what this video is about. This is about 10 traps that hit millennial households in their 40s, whether they've been doing everything right, and the worst ones are not the obvious ones. Nobody is talking about trap number 5. And by the time I get there, you are going to want to reread every single financial assumption you have ever made about your retirement. Here's the layer most finance content skips. This generation has absorbed 2 full economic catastrophes before age 40. The oldest millennials entered the workforce around 2003, only to face the Great Recession just a few years later. At one point, more than 15% of millennials were unemployed during that downturn, and many who kept their jobs had wages that were stagnant for years. Then COVID hit, right as the youngest millennials were hitting their prime earning stride. That's not an excuse, it's context. Because by the time you reach your 40s, you have been running a financial sprint on a series of broken legs. And now the race gets harder, not easier, while the crowd keeps applauding and telling you your peak earning years are here. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the weak points in your plan, and I only ask for your email to send the report so I don't store any of your financial data link in the description. So here is the central image I want you to hold in your mind for this entire video. A treadmill. Not a gentle gym treadmill. An industrial one on a 10% incline that keeps accelerating without warning. Your income is going up good. You bought the house good. Your career is moving great. But the treadmill got faster. The cost of one parent's care went up. Your kid's tuition went up. Your insurance premiums went up. Your property taxes went up. Every trap in this list is another anonymous hand pressing the speed button. And the cruelest part of the treadmill metaphor is that from the outside, you look fine. You're still moving. You're just not going anywhere. In a few minutes, I'm going to show you what the sandwich generation actually costs. A 40-year-old in real dollars, and the number is going to be more than most people spend on their kids' college tuition. But first, let me start somewhere most financial content never starts. Not with a savings shortfall, but with a machine quietly eating your savings from inside your plan right now. Here is trap number 1. And it is not about what you contribute. It is about what gets extracted from you automatically, invisibly, every single year you stay invested. The US Department of Labor put it bluntly. A 1% difference in fees will reduce your retirement account balance by 28% at retirement. Not 1% less, 28% less. Think about what that means in your actual dollars. According to a Q4 2025 report from Fidelity, the average millennial 401k balance is $83,700. If you are 40 years old with $83,700 in a plan charging 1.5% in combined fund expense ratios, which is completely normal and often invisible, versus a plan with 0.5%, which is achievable with index funds, you will retire with roughly $180,000 less. That is not a rounding error. That is a car, a boat, and 4 years of tuition. Here's where it gets really interesting. Most millennials inside employer-sponsored plans have no idea what their expense ratios are. None. They chose a fund by its name, its 5-star Morningstar rating, or because their HR rep pointed at it during onboarding. I did the same thing in my first business. It took my accountant about 45 seconds to tell me I was in a plan charging 1.1% when identical index exposure was available at 0.03% inside the same plan. Over 30 years, a 1% fee drag on $200,000 costs you $170,000 in lost compounding. The treadmill got faster, and you were paying for the electricity. What's the fix? 12 minutes. Log into your plan, find the Fund Details tab, look for the expense ratio column. If any number is above 0.5%, check whether a comparable index fund exists inside the same plan. In most corporate plans, it does. You switch, you set it, you never think about it again. That 12-minute decision is worth more per hour than any side hustle you could take on. Now, the benchmark problem. And this is where people's brains tend to break, so stay with me. Fidelity suggests having about 3 times your annual salary saved by 40. With median millennial household income around $71,000, a 40-year-old millennial should have roughly $213,000 saved. Vanguard's median for the 35 to 44 age group was just $39,958. meaning half the generation has less than $40,000 saved at the exact moment the benchmark demands $213,000. That is not a modest shortfall. That is a structural problem. But here's the trap inside the trap. You think the problem is the $173,000 gap. It is not. The actual problem at retirement is closer to $700,000 because of compounding. $39,000 growing at 7% annually for 25 years becomes roughly $212,000. $213,000 at the same rate becomes roughly $1,156,000. You don't lose $170,000. You lose nearly $1 million of retirement wealth because of a gap that existed at 40. The treadmill doesn't just accelerate, it multiplies. And here's the thing, nobody explains about being behind at 40 versus being behind at 30. At 30, one extra decade of compounding can close almost any gap. At 40, you are in the final 25-year sprint. Every year of delay now compounds against you. It is asymmetric and it is ruthless. Goldman Sachs' 2025 retirement survey found that 59% of millennials experienced at least one major life disruption in the prior 2 years of home purchase, a divorce, a marriage, or college costs that disrupted their retirement savings. As a result, 70% of respondents reporting a life event either paused retirement saving contributions, took a retirement plan loan, or planned to retire later. That is the trap. Not one catastrophic decision. A perfectly rational human sequence of decisions that adds up arithmetically to a catastrophe. Now here's the behavioral reversal. You think the problem is that you're not saving enough. The actual problem is that your expenses are structurally designed to grow faster than your income. And no amount of individual discipline can outrun a design flaw in the system you're living inside. Which brings us to trap number 2, the lifestyle velocity squeeze. And it's more sophisticated than most people give it credit for. There's a well-documented pattern in behavioral economics called lifestyle inflation. Your income goes up 15%, your spending goes up 12%, you net 3% and feel responsible. In isolation, you are. The problem is that in your 40s, you hit multiple simultaneous inflection points in cost, and they don't feel like inflection points. They feel like normal life. The cost of homeownership went up to 51% of median household income in 2025, from 33% in 2 to 1,000, an 18 percentage point increase. Over the same period, the cost of private college rose 20 percentage points to 85% from 65% of median household income. These are not lifestyle choices. They are structural increases in the price of a normal middle-class life. The CPI has risen 26% in the past 6 years. The treadmill got faster while you were standing still. And here is the kicker nobody discusses. Your 40s are when you make your most expensive non-financial decisions. You renovate the kitchen $15,000 to $60,000, cash or equity. You upgrade the car because the 15-year-old Camry finally became embarrassing. You start funding the college savings account because your kid is 12 and the clock is suddenly audible. Every single one of these is completely rational in isolation. Together, they are a structural bypass of your wealth-building system. There's a pattern here that I've seen described again and again. Think of a physician named Andrew, completely fictional composite of a very recognizable archetype. He earns $260,000 a year at 43. He had about $90,000 in his 401k at 35 because residency paid nothing and his first attending salary went entirely to student loans. He was behind, so he maxed the 401k. He invested outside the plan. He felt like he was accelerating. And then his mother was diagnosed with early stage dementia. His daughter got into a school that cost $72,000 a year. His wife decided they needed more space for a third child. Each of those decisions was made independently as a responsible adult in its own financial context. By 46, Andrew was contributing less to retirement than at 43 because cash flow had been consumed by normal life. The treadmill ate him, and Andrew earns $260,000. Most people watching this are not. By the way, hit subscribe if you like the content. Otherwise, YouTube's algorithm may never show you my videos again. And we're about to get into the trap that hits 54% of people in their 40s. And the dollar amounts involved are genuinely alarming. Trap number 3, the sandwich press. More than half of Americans in their 40s, 54% have a living parent age 65 or older and are either raising a child younger than 18 or have an adult child they're helping financially. More than half. and the financial pressure is growing. The share of Americans who identify as part of the sandwich generation who say they are financially exhausted by parental caregiving has increased over the past 3 years, with 69% reporting financial pressure, up from 64% in 2022. Now let me give you the numbers nobody puts in the same sentence. According to Genworth's Cost of Care survey, the median annual cost for a private room in a nursing home in the United States is over $116,000. Even in-home care can cost upwards of $75,000 per year. If your parent doesn't have long-term care insurance, and statistically they don't, that cost falls to family, which means it falls to you. That's not a medical expense. That is a structural financial event that has nothing to do with your income, your savings rate, or your financial plan. Here's the psychological layer that makes this particularly brutal. Nobody budgets for it. You budget for your mortgage, your car payment, your vacation. Nobody puts mom's dementia care, year 1 through 7, on a spreadsheet. It arrives as a surprise, and by the time it arrives, you are in the middle of what should be your peak compounding years. So I'll just, wing it with the spare bedroom and some meal prep. Yes, 69% of people in this exact situation say that. $78,000 later, the spare bedroom has a hospital bed in it. And here's the stat that I find genuinely disturbing. More than half, 57% of sandwich generation caregivers said they have had to choose between their career and caring for their parents, more than double the 26% reported among adults overall. You're not spending the money, you are also losing the income. The treadmill didn't just accelerate, someone removed 2 of the guardrails. Many caregivers spend an average of 50 hours per week on caregiving duties, essentially a second full-time job. Except this one pays nothing, offers no 401k match, and actively costs you compounding time. Now let me introduce someone I'm going to come back to. Call him Marcus, 44 years old, software engineering manager in the Pacific Northwest. Makes solid money, $142,000 a year, has a house with decent equity. His 401k is better than average, but his mother moved in 2 years ago after hip surgery that was described as temporary. It is not temporary. We'll come back to Marcus. This is where it gets really interesting. Trap number 4. And this one requires me to change your mental model about something that seems harmless. You think the problem with borrowing from your 401k is the interest rate. The actual problem is everything that happens around the interest rate. Loan use from retirement accounts rose for the 3rd consecutive year in 2025. 26% of workers reduced their individual contributions that same year. Here is why that combination is a death spiral. You take a loan from your 401k, let's say $40,000 for a home renovation or a medical event. You tell yourself you'll pay it back, and the interest you pay goes back to yourself. So it's basically free. That is the version the plan administrator implies. Here is the version they skip. While your $40,000 is outside the market as a loan, it is not compounding. That $40,000 at 7% over 10 years would have become $78,700. You don't get that. The interest you pay back to yourself is earned with after-tax dollars, and then when you withdraw the money in retirement, it gets taxed again as ordinary income. You have effectively paid double tax on the repaid interest. And if you leave your employer before the loan is fully repaid, which happens to a significant share of plan participants within 5 years, the entire outstanding balance becomes a taxable distribution. If you are under 59.5, you owe ordinary income tax plus a 10% early withdrawal penalty on the full outstanding balance, meaning the $40,000 loan could trigger a $12,000 to $15,000 tax bill in the year you least expect it. Most people who take 401k loans are not irresponsible. They are the people financially disciplined enough to have a balance large enough to borrow against. They're not broke. They're caught in the gap between income and the structural cost acceleration of midlife. And the 401k loan becomes the escape valve, convenient, quick, no credit check, no hard inquiry. The trap looks like a solution. Now, I need you to stop thinking about individual traps and start thinking about a system. Because trap number 5 is not a personal finance trap, it is a policy trap. And it lands on you whether you've made every correct individual decision or not. But here's what nobody is telling you about it. Stay with me, because this next part changes the math on everything else I've said. Social Security's actuaries estimate the Old Age and Survivors Insurance Trust Fund will be depleted by Q1 2033, about 7 years from now. When the trust fund is depleted, automatic benefit cuts of 17 to 23% kick in unless Congress acts. Not could kick in, the statute requires it. Social Security will exist. The program collects payroll taxes indefinitely, but the check is almost certainly smaller than what the current projection shows. Now, here is why this matters specifically for millennials in their 40s. If you were born in 1985, you become eligible for full Social Security at approximately age 67 in 2052, 19 years after the projected trust fund depletion. You are building a retirement plan around a benefit that the actuaries themselves project will be reduced, and the default calculator on most banking websites uses the full projected benefit. Vanguard's 2025 data projects that only 42% of millennials will maintain their current standard of living in retirement. 42%. Meaning if you're watching this with two friends who have similar incomes and savings, one of you statistically doesn't maintain your lifestyle. And nobody told you at the start of the race. The practical implication: your personal savings need to replace not 40% of pre-retirement income, the historical Social Security assumption, but 60 to 70%. Americans think the magic number for a comfortable retirement is $1.46 million, according to Northwestern Mutual's 2026 Planning and Progress Study. With a reduced Social Security benefit, that number almost certainly needs to go higher, but the number most millennial retirement plans are using is calibrated for full benefits. The treadmill got faster, and the finish line just moved. Here is the sardonic part. The prescription for this is not exciting, it is not a hot stock, it is contributing more earlier to tax-advantaged accounts. Boring, repeatable, lazy. The people in the best shape right now are not the ones who found the right crypto trade or the right sector bet. They are the ones who set up an automatic contribution in 2015 and never touched it. Let me come back to Marcus for a second. Marcus knows about the Social Security thing vaguely. He's thought about it the way you think about your car needing a new timing belt eventually. You know it's coming. You're just not dealing with it today. Meanwhile, his mom is in the guest room. His 401k has an outstanding loan from when the furnace and the roof both failed in the same month. His daughter is a junior in high school, and there is a very real conversation happening about university. Marcus has not opened his retirement account projections in 11 months. The math is stacking in a direction he hasn't looked at directly. We'll resolve his situation at the end. Now let's talk about trap number 6. And this one is specifically a 40s trap. It does not appear in your 30s with nearly the same force. The college versus retirement prisoner's dilemma. According to a 2025 Advisor Authority study, 58% of millennials reported feeling like they had to choose between homeownership and retirement. The same psychological tension applied to your kid's college is even more visceral because it involves a person you love, not a building. No parent is going to tell their 18-year-old to take out loans so you can max your Roth IRA. No one does that. And no financial article ever honestly acknowledges that the rational calculation and the human calculation are completely different things. Here is what the math says, coldly. You can borrow money for college. There is no such thing as a retirement loan. A parent who diverts $300 a month from their 401k into a 529 plan at age 42 does not lose $300 a month. At 7% over 23 years, they lose roughly $2,200 per month in potential retirement income using a 4% withdrawal rate. That is the arithmetic version of the trade-off. The human version is that you want your kid to graduate without $150,000 in debt, which is one of the most understandable parental instincts on earth. I'm not telling you not to fund the 529. I'm telling you that when you're choosing, the trade-off is not $300 a month. It's a structural hit to your retirement that compounds silently for 2 decades. Private college tuition went from 65% to 85% of median household income over the past 25 years. If you had your kid at 35 and they start college at 18, you are 53 years old when the first tuition check clears. Right in the middle of the final sprint where every 401k dollar should be accelerating, not decelerating, because your window to retirement is now inside 12 years. Trap number 7, the home equity illusion. There's a story that cycles through millennial financial discussions like folklore. Real estate always appreciates. So the equity in my house is essentially my retirement plan. I understand the logic. Housing prices have been extraordinary in the past 15 years. But there are three structural problems with this reasoning that become acutely visible, specifically in your 40s. One, your house is not liquid. It is not accessible without selling, where you also have to live, or borrowing against it, which converts equity back into debt. Two, the cost of maintaining a home accelerates dramatically in your 40s. The roof that was 10 years old when you bought it is now 25 years old. The HVAC is failing. The water heater is going. The original windows are leaking heat. Homeowners in midlife spend, on average, 1 to 2% of their home's value annually on maintenance. On a $400,000 home, that is $4,000 to $8,000 per year money that never appears on any savings projection but consistently disappears from investable cash. 3. With high interest rates, rising insurance premiums, and cash flush investors snapping up single-family homes, millennials who are renting are often paying more in rent than they would on a mortgage if they could get in. And those who got in are now seeing equity gains that push against the capital gains exclusion thresholds in appreciating markets. The danger is treating home equity as a savings substitute. It is an illiquid leverage bet on a single asset that you also need to live in. Every time you mentally included home equity in your retirement calculation instead of your 401k balance, the treadmill got a little faster. Trap number 8, the disability insurance blind spot. And this might be the most consequential trap on this entire list, specifically because virtually nobody talks about it. The standard financial conversation is about life insurance. You need enough to replace your income if you die. Fine. But here is the number that reframes everything. According to actuarial data from LIMRA and the Social Security Administration, the probability of experiencing a disability lasting longer than 90 days before age 65 is roughly 1 in 4, 25%. The probability of dying before 65 is considerably lower, which means the product everyone buys life insurance covers the less likely scenario, and the product almost nobody buys long-term disability insurance covers the far more likely one. If you're a 40-year-old earning $90,000 a year and you become disabled for 5 years, the income loss alone is $450,000. Plus, you have stopped contributing to retirement for 5 years, which at 7%, compounding costs another $150,000 to $200,000 in projected retirement wealth. That is $600,000 of financial damage from a single health event. Most employer short-term disability covers 60 to 70% of income for 90 to 180 days. After that, on most plans, you are on your own. Historical data from Vanguard illustrates that the non-housing debt burden for millennials at ages 35 to 38 was approximately double that carried by baby boomers at the same life stage. If you are carrying that debt load and lose 60% of income for a year, you do not pause. You go backward in ways that take 5 years to recover from, if ever. An individual long-term disability policy covering 60% of gross income to age 65 costs roughly 2 to 4% of gross salary in annual premiums, depending on your occupation and health history. For someone earning $90,000, that is $1,800 to $3,600 per year. For business owners, premiums can be structured as a deductible business expense. For employees, premiums are not deductible, but benefits, when you receive them, are tax-free. An important distinction when comparing policy options. Nobody buys it because it's boring. It doesn't feel urgent. And the scenario you're insuring against being unable to work for years doesn't fit how you think about your own future. Until it does. Trap number 9. The peak earnings phantom. Here's a belief that is simultaneously true and dangerous. Millennials in their 40s are entering peak earnings years. Millennials born 1981 to 1996 are now in their peak earning years. And median earnings for 45 to 54-year-olds are the highest of any age bracket in Bureau of Labor Statistics data. Also true. And here is the dangerous part. Peak earnings alone will not rescue a 15-year savings deficit in a 10-year sprint. The math does not work. Let me show you. You have $83,700 saved at 40, the actual Fidelity average. You need $1.46 million by 65. That's 25 years. At 7% annual return, your existing balance grows to roughly $454,000 without additional contributions. You need to close a gap of just over $1 million through contributions alone. To do that at 7% over 25 years, You need to contribute approximately $14,900 per year consistently without interruption for a quarter century. That is doable at higher incomes, but it requires zero interruptions. No 401k loan, no contribution pause, no year where a major life event redirects cash flow. 70% of respondents who experienced even one major life event either paused contributions, took a retirement plan loan, or planned to retire later. You will almost certainly experience at least one major life event in the next 25 years. So the model breaks. Peak earnings will save me is not a financial plan. It is an optimistic assumption wearing a suit. And then there is the tax bracket trap that sits underneath peak earnings like a landmine. You earn more in your 40s, which is also when the mortgage interest deduction shrinks because you've paid off enough principal that the interest component is smaller. The child tax credit phases out as kids age out of eligibility. Dependent care credits disappear. The deductions that subsidize your effective tax rate in your 30s start evaporating right as your income is highest. Wages and salaries rose 3.6% over the 12 months, ending June 2025. Only modest real gains once adjusted for price growth, and the bracket creep means you're surrendering a higher percentage to taxes right as you need every dollar for compounding. Trap number 10, the insurance scope creep nobody audits. This is the quietest trap on the list. As you enter your 40s, you start accumulating insurance policies the way people accumulate streaming subscriptions one at a time, each individually justified, collectively chaotic. Homeowners insurance, auto, umbrella, life, pet, dental, vision, critical illness. And in most cases, the coverage on each policy was set when you were in different financial circumstances. You bought a $1 million life insurance term when you had a $200,000 mortgage and no kids. Now the mortgage is $350,000, you have 2 kids, and you haven't looked at that policy since the Clinton administration was a current reference. Here's the scope creep angle. Insurance companies count on you not reviewing. Premiums auto-renew. Riders accumulate. Duplicate coverages stack. Many Gen Z and millennial customers with increased insurance rates took no action to reduce their costs. 33% for homeowners, 41% for auto, 50% for renters. The passive behavior is costing you money you can't see. A full insurance audit comparing what you actually have, what you actually need, and what it actually costs takes about 4 hours and routinely reveals $3,000 to $5,000 of annual premium that either duplicates coverage or insures risk you no longer carry. That $3,000 annually invested at 7% for 20 years is over $123,000 at retirement. Not dramatic, but quiet and consistent. Now, let me put real numbers on all of this in one place. Marcus, 44, software manager at $142,000 a year. He has $112,000 in his 401k, better than the median. He owns a home worth $480,000 with $190,000 in equity. His 401k has an outstanding loan of $32,000 taken 3 years ago when the furnace and roof failed in the same month. His mother moved in after a hip surgery. The assisted living facility quoted him $57,600 a year. The family decided to handle it at home instead. His wife scaled back to part-time to manage caregiving. His daughter is a junior in high school, and the 529 account has $19,000 in it. Here is Marcus's actual retirement picture. His 401k, with the loan reducing his investable balance, is effectively $80,000 compounding. His savings rate has dropped to 9% because loan repayments are consuming cash flow. Fidelity found millennials have just an 8.9% savings rate as of Q4 2025, which is less than Gen X at 10.4% and baby boomers at 12.4%, while experts recommend a 15% rate. Marcus is exactly at the millennial average, which means he is exactly at the problem. At 65, assuming 7% annual return and modest continued contributions, Marcus is looking at roughly $450,000 from retirement accounts. His home equity, assuming he sells and downsizes in 20 years, nets $120,000 to $150,000 after transaction costs and capital gains exposure. Total around $600,000. The magic number is $1.46 million. The gap is $860,000. Marcus is not a financial disaster. He is a financially average millennial doing financially normal things inside a system where doing financially normal things produces a structural retirement shortfall of nearly $900,000. Here is what Marcus actually did with this information. First, he audited his 401k fund selections, found 72 basis points of hidden expense ratio drag, moved to index equivalents in the same plan. That single decision is worth approximately $83,000 at retirement. Second, he aggressively overpaid the outstanding loan balance, cleared it in 14 months instead of 3 years. The money that had been losing compounding returned to the market sooner, and the double tax problem stopped. Third, he contacted Washington State's Home and Community Services Division and discovered his mother qualified for a Medicaid home and community-based services waiver that covered a meaningful share of in-home care costs. He had been absorbing personally without knowing state programs existed specifically for this situation. 3 decisions. None required a dramatic lifestyle change. All of them required reading documents that most people never open. 10 years of passive assumptions was the real trap. 3 practical takeaways specific to your 40s, not generic advice you've already ignored. First, audit your 401k expense ratios this week, not this month. If your blended expense ratio is above 0.5%, find the cheapest available index fund in your plan and switch. Log in, look at the fund detail, find the expense ratio column. This is the highest return 12-minute decision available to most adults. Second, if you have or expect to have a parent needing care in the next decade, research your state's Medicaid home and community-based services waiver program before you write a single personal check for care. These programs exist in 46 states and are massively underused. The income and asset thresholds vary by state, so check your specific situation. This research takes 1 afternoon and can save tens of thousands of dollars annually. Third, get a long-term disability insurance quote in the next 48 hours. Call a fee-only independent insurance broker, not a captive agent representing one company, and ask specifically for an own occupation policy that covers you to age 65. Compare at least 3 carriers. The premium will surprise you with how affordable it is relative to what it protects. Lazy investing built more fortune than crypto memes, and the treadmill is still on. The only question is whether you're the one who pressed the speed button or the one who figured out where the emergency stop is.